From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for January 21st, 2022. The frozen tundra will live up to its name Saturday night when the Packers host the 49ers in sub-zero wind chills. And your Milwaukee Bucks welcome the Knicks and the Kings to the Forum this week. When Norwegians muster out of the military, instead of a thank you for your service, they're ordered to return their underwear, bras, and socks. Norway does this so the next group of recruits has something to wear. Man, I'd hate to die in battle wearing someone else's bra. Things are beyond crazy in Napa Valley. A house with no bedrooms and one non-functioning bathroom and no working appliances and can only be described as a handyman's delight sold for $2 million cash. Just how much wine do they drink in Napa Valley? A 55-year-old guy from Manhattan who can generously be called a basement dweller is suing his 82-year-old mother for not giving him his baseball cards. The lawsuit states, Mom reneged on the promise to let me have the cards when I turned 55. Mom said her son needs a timeout. Researchers at Cardiff University have found face masks make men and women look more attractive to the opposite sex. My guess is later that evening, when the masks come off, you'll be able to cut the disappointment with a knife. Our goofy headline of the week, China using the ocean to hide submarines. I think it's right in the name, duh, submarine. On the podcast today, we have Brian Kild, Kyle Tedding, Paige Ratke, Joel Tresack. And wrapping up the week, here's Bob Landis.
Thanks, Max. Pretty ugly week. Nasdaq in correction territory. This week shed 7.6%, losing 1,125 points. That's a lot to close at 13,769. Broader markets held up just a little bit better, lost 5.7%. S&P 500 lost 265 points this week, closing at 4,398. The Dow Jones Industrial average gave up 1,646 points this week. It's a lot considering we were only trading for 4 days. Losing 4.6%. Closed at the bell this afternoon in New York with the Dow finishing the week at 34,266. 10-year Treasury yield came down just a tad after hitting 1.86% yield on Wednesday. Closed today yielding 1.75%. Kyle, last week on the podcast, we were talking about how the sell-off was sparked by the release of the Federal Reserve Open Market Policy Committee meeting notes early in the month that surprised many investors. Stocks have been kind of selling off ever since. Consensus only a month ago was for 2, maybe 3 rate increases. The thought was that maybe they'd start raising rates in June. And now the futures market in Chicago is now predicting 4, maybe 5 rate increases to occur this year. As we all know, it is about interest rates and earnings. Interest rates head up, certainly creates volatility for stocks. Tough way to start the year. Nasdaq in correction territory, down 12%. Broader markets down 7.7%. Dow down 5.6%. I thought it was interesting to see on a relative basis how well some of the value stocks have held up. Many of them are underwater, but by 1 or 2%, not by 12% that the Nasdaq shows. Kyle, if you think about the forecast that we're reading, many experts are predicting that inflation should in fact peak out in this current quarter, the first quarter of the year. Inflation could be down to 2.5% to 3% by the end of the year. But here's the basic problem. We're not going to know if inflation's peaked out till late in the spring, maybe even into the summertime. So relative to the $64,000 question of how high are rates going to go, and how much will that choke off the potential recovery is yet to be seen. So I think folks are going to need to be patient here. There are plenty of ways this could play out. Stocks could just trade sideways for a while. We could have a continued sell-off. Typically, we get rallies even in a sell-off. We saw that early this week with, yesterday is one example. Wednesday is another, where we opened pretty strong only to finish down. So that shows that, the market wants to go up, but the seller's overwhelmed. So, Kyle, what's your take on things?
Yeah, I think as we entered this week with a blackout in terms of, conversation from the Fed ahead of next week's policy meeting, I think there were a lot of, investors that were left to just kind of ruminate on what's been said so far this year and maybe what potentially could happen. I think, you rightfully point out that the most important question right now is what the Fed does in response to some signs of inflation, what they do to normalize interest rates, what they do to unwind the balance sheet. Of course, the problem we have is that we're not going to immediately know what the impact of those decisions are, in part because it takes the market a little while to digest those decisions, and in part because it takes a little while then to get the feedback from the actual underlying data, which is always delayed. And so we seem to be operating right now in kind of a bit of a delay, right, where we're reacting to what we think is going to happen, but we won't actually know what happened until a couple of months from now, and that cycle will go on for a little while. And so what that lends itself to sometimes is things swinging a bit too far in one direction. Not to say that that's where we are right now, because I think the potential exists for this to carry on a bit longer. There's certainly enough pressure in the market. There's certainly enough technical indicators indicating that, volatility is going to be around for a while. But the reverse of that is that when you operate in this vacuum of information, right, when you operate in an environment in which we're waiting for information that isn't going to be here for a while, I think you have a tendency to swing a little too far one direction. Eventually, we hopefully see things come back the other way. I think certainly if you wait long enough, you're going to be, as an investor, happy about the ultimate result. But I think the challenge is that at least for a while longer, and certainly until the 26th, when the Fed has their meeting, we don't have a lot of information to act on. And so, we got a couple more days here for markets to be open without good information. And then even beyond that, little intention that the Fed makes a move next week. There doesn't seem to be much that suggests that that's in the cards. But unfortunately, without much from the Fed this week and early next week, it's difficult to know. And so I think the real trick right now is avoiding making decisions as an investor based on volatility that we're seeing, based on kind of an absence of information. The reason to make a decision for your portfolio is because of information you have, not information you don't. And I think that's what we're dealing with right now.
Brian, when you look at the forecast for gross domestic product growth for this year next, pretty encouraging. Forecast now 3.9% GDP growth for this year, 3.5% growth hopefully next year. I mean, as you know, the long-term trend line's been 2%, give or take, growth for GDP. So the stock market's not the economy, of course, but we do have the backdrop of fairly good economic growth for the next couple of years.
Bob, I do think it speaks to, people have a tendency to swing from being overly optimistic to being overly pessimistic. And I think that in itself is the case for things not getting too bad from here on out, because the underlying economy is strong. People are spending money, which keeps things going. Corporate earnings forecasts still are really strong. And, they may get a little bit worse or a little bit better from here. But, in the short term, we all know that emotionally momentum kind of disconnects you from the market in the short term. And I think that's what happens. We had a lot of optimism in the last couple of years. And I don't know that fundamentally things have changed much since, the last 3 or 4 weeks, but people have seemed to have woken up a little bit and been a little more pessimistic. And, you're seeing some of these folks come out of the woodwork that always do at this time, Jeremy Grantham and Jamie Dimon speaking, some pretty negative stuff, which people kind of glom onto, and then the momentum starts to swing a little bit the other way. So, I'm encouraged by much of the underlying fundamentals as you are, but it could get a little wild here in the short run because it always does, right?
We're still dealing with COVID. We were talking just before we went on the air about how many people we all know that have contracted COVID recently. And although preliminary evidence is suggesting that the rate of infection is starting to recede, we're not going to know that for a while. So there's always that potential. But it is about interest rates and earnings. And I think it's important to remind investors that even with 4, maybe 5 quarter point rate increases, by the time the Fed is done, rates are still going to be fairly low. And when you look at stocks that pay nice dividends, there's still plenty of opportunities out there where the dividends on the stocks are more than you can make on bonds. So that will help support stock prices moving forward as well.
Bob, I think that's an important point in terms of we haven't talk about things like interest rates in kind of binary terms. They're either up or down, or inflation the same way. And it's not really, it's where it's going to end up at the end of the day. And inflation will come down. It's probably going to stay higher than it was a year ago, and interest rates will be the same thing, and I think at the end of the day, you would guess that inflation will be a reasonable level and interest rates will still be relatively low. And that, on top of strong earnings and a growing economy, should give us something to look forward to down the road, I think.
Kyle, you were going to jump in and say something?
Yeah, my bad, Kyle.
Yeah, I just wanted to point out that the forward earnings yield on the S&P 500 right now is better than 5%, with a forward PE ratio below 20 now. And we were talking towards the end of the year last year about a forward PE that was approaching 22. And so one of the benefits of these types of sell-offs is it makes an expensive market looks significantly less expensive. It isn't the way we typically want to get there, right? You want to grow the earnings number, not shrink the price number. But I don't think we're talking about the extreme valuations anymore that we were talking about, towards the end of the year last year with, the forward earnings yield right now over 5. That's significantly better than what you're getting on even some lower quality corporate bonds. And so I'm pretty excited about the opportunities that are out there. Just got to get through the volatility that's here right now.
Paige, why don't you jump in? What's your take on current events?
Yeah, so obviously I just want to reiterate that the volatility right now is very real. And I know that it causes a lot of anxiety for investors. And I think we have the tendency to try to find a rationale behind a move on a given day. But oftentimes, as Kyle was saying earlier, there's nothing clear and obvious that triggers it. And it's just a good example of why we don't try to time the market. I think most of the damage that we're seeing right now really is the perception of what may happen rather than what's actually happening. And anytime you see excess volatility without actual underlying data to support it, I think it's always something that you should be wary of. In addition to that, I did a little bit of a deep dive on some of the earnings calls that have been coming out, because that really is the most important thing. And, obviously we're still early in this earnings season and lots of reporting still has to be done. But the primary things that you're seeing across these earnings calls are labor costs and shortages, COVID costs and the impact of COVID, supply chain disruptions, transportation costs. So all of the same things that we've been talking about for the last year continue to be the issues that are plaguing these companies. And so ultimately it comes down to finding a way to clear those issues out. And while, from an inflation standpoint, we all like to point at the Fed and say that's their responsibility. There's only so much they can do with interest rates, and that's not going to suddenly make people come out of the woodworks and start getting jobs. So I'm really keeping an eye on labor and looking at the cost of labor. But I think more importantly, because we have inflation as high as it is, we're seeing businesses pass that along to consumers. For the most part, we've been able to stomach it. And so, hopefully the corporations out there find a way to work through this. And when we start to get more companies reporting their earnings, we see the market reflect those moves rather than focusing on all the negative aspects of what they have to say.
Joel, we had a couple of economic reports this week that I found interesting. Home sales 15-year high last year. Weekly job claims jumped pretty good because of COVID disruptions.
Right, yeah, Bob, we had a couple of numbers on housing. The existing home sales, as you said, at a 15-year high for 2021. Also, housing starts and building permits, those numbers are hovering around where they were in 2006. So even though those are pretty volatile month to month, they're still pretty high. And housing, even though it's not a really big part of the economy overall, it represents the biggest consumer expense for a lot of people, the biggest investment that people make outside of their investments. And it's really kind of a telltale of what's going on in the economy, and some of the list that Paige just made of the things that are going on with high demand for things and supply chain constraints, and that's pushing up prices. The home sales for the National Association of Realtors reached an all-time high, a median of $350,000 for 2021. So that's what's happening there. It's been 118 months in a row that the year-to-year price of houses has been going up. So the questions are, how long will all of this last? And what happens after that? And as you also mentioned, the unemployment claims up a little bit the last few weeks, but that's after hitting the lowest point since 1969. So overall, the economy is doing pretty well. And we had the leading economic indicators come out today from the Conference Board, and they're saying, despite all these things, despite Omicron, despite tight labor market, despite inflationary pressures, and even the expected interest rate hikes from the Fed, they're seeing the economy continuing to grow, maybe 3.5% for full year 2022. So as you pointed out at the top, that's a pretty good rate of growth.
Kyle, let's spend a minute talking about the beauty of building balanced portfolios. So often when you manage money, people are asking you for your forecast. And, my basic response is, I really don't know what stocks are going to do short term. Long term, I got a pretty good idea how it's going to work out. And, you think back 2.5 years ago, I never even heard of COVID. You think about it and how much it's dominating our lives now. It wasn't even on my radar screen 2.5 years ago. So things come up that surprise you. That's the whole point of making sure you have 60-ish% in stock, 40% in bonds. We know from the modern portfolio theory studies that you get much past 60%, your risk line keeps going up, your return line flattens out. So you're not being paid for the risk you take. So it's very important for people to remain balanced and to remember why they do it in the first place. So that no matter what plays out, hopefully you got your bases covered. And it's important to revisit your balance every now and then. Stocks continue to sell off. Think about at some point a conversation with your advisor and potentially rebalancing, and it just forces your hand to buy when prices are a little bit lower. But Kyle, why don't you spend a minute on the beauty of balancing?
Yeah, Bob, I think you hit the nail on the head with maybe your last comment, and that is the point in time in which we start to feel a little uncomfortable about how bad things have gotten. That may be the point in time in which you're ready to lean back into risk a little more. And the beauty of that balanced portfolio is that, if you've got 60% in stocks and you've got 40 in kind of that safer piece, when the stock component sells off a little bit and you start to feel like maybe it's gotten a little overdone, or maybe you feel kind of like, okay, this could go on for a while, you've got that other piece you can lean on both for portfolio withdrawals, but also as dry powder to add a little risk back to the portfolio as prices come down, to take advantage of some of those prices. And so, I think we use this word balance as a way to say, this is kind of the long-term strategy. but it doesn't mean that we're not doing anything along the way. There's a couple of different components I think we have to remember that are happening they're very active. First and foremost, our own decisions about what that balance looks like, leaning into areas of opportunity, leaning away from areas of risk, but also within the portfolios themselves, within the mutual funds that so many investors hold, there are decisions that are happening all the time about what the right stock or sector to own is. And so I think, the beauty of balance is that it doesn't count on being 100% correct about timing and direction. It counts on general trends with the ability for investors to kind of, make small changes here and there based on what opportunities are out there. And so, I think that's really the critical point. Is it doesn't mean we're not doing anything. It doesn't mean that we're entirely passive and that your portfolio is never going to look different. It means that the very nature of balance allows us to make those changes rather than being forced to make them because we're concerned that we were overly aggressive when we're caught by surprise. There's always going to be things that catch us by surprise. There's always going to be things like COVID that, we hadn't heard of 2.5 years ago. And if anything, I think the world's probably moving a little faster now than it did, 15, 20 years ago, in that there are new technologies, there are new diseases, there are new treatments that 2.5 years from now we haven't even considered. And so, that long-term balance allows us to capitalize on those things we maybe haven't seen coming yet, but also, navigate the risks of what that brings as well.
Well, thank you for that answer. Well, folks, that's the end of yet another Money Talk. Thanks for listening to the program. We'll talk to you next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.